The Rebel Capitalist Show.
Another thing I was thinking through, and I tried to go through this thought experiment the other day, is ask myself if the Fed would not have kept interest rates artificially low since, let's say, the GFC, or even going back to 2000, how would the economy and the supply of what we need be different, right? Because, I asked myself, would Twitch even exist? Because if investors could get 7% on a 10-year treasury since 2000,
would they have invested in money
exist?
losing? Right. Would they have invested in WeWork? Right. Would they invest in
would they invest
businesses?
in stuff that we actually need that's pulled up out of the ground? Would there be an incentive? Would there be a less of incentive for this ESG push? That's something I think about all the time. I think that because the stock market has pretty much gone straight up for the last 12 years, and for most of these young people that are really environmentally conscious, let's say, or really want to invest in these ESG funds, they only know the stock market going one way. So if the stock market's always going to go up, why should I invest in an oil company when I can just give it to Larry Fink with BlackRock and he can invest it in some sort of woke business, right? Where they don't understand that making money and investing is very, very difficult. And the stock market goes up, but the stock market goes down as well. And it can go down for a long, long time. Japan teaches us that, back in the 90s. So therefore, if we wouldn't have had this Fed put, would the ESG movement be so strong? And would Germany be in the place it's in right now, where it's held hostage pretty much by Russian natural gas, if you would not have had the Fed or the central banks trying to manipulate the economy for the last 10 or 15 years?
I think those are great. I think those are really, really great points that future historians will debate with the same vigor that people today wonder what would have happened to Nazi Germany if Hitler hadn't invaded Russia. These kind of historical what ifs. If they hadn't done that, if Gavrilo Princip hadn't assassinated Archduke Franz Ferdinand, would there have been a World War I and hence a World War II? And all those things if the Fed had, but when you think about it, you can walk that dog all the way back to, the 90s and say, but if Greenspan hadn't, done this, then they wouldn't have had to do this. And there wouldn't have been the tech bubble and, and all these, different things. Pets.com would have never have existed. And, hard to say, but I think you make some very valid points. I think you make some very valid points. I think the one thing I think about with that, though, is throughout all of human history, and certainly the measurable economic history, and there's a lot of measurable economic history. We can look at, we can go back and look at we can look back at economic records in ancient Mesopotamia, right? These are chiseled on cuneiform tablets. We can see what tax revenues were in the Ottoman Empire and the French Bourbon monarchy. And so we have a lot of data. And it's very obvious, and it's just a historical fact that economies always go through cycles. There's an up cycle and there's a down cycle. And I think people always find a way to engineer a down cycle because they have managed to engineer too much excess in the up cycle. And so I think they would have figured out a way to eventually sort of get to this point, regardless. And we can even look back in US history. I wrote about this recently. If you look at, a period from, let's say, the outbreak of World War I to the end of World War II, it's about 30 years. Most of that, there's some exceptions like in the late 20s, et cetera, but most of that was chaos, war, economic hardship, a lot of suffering. And then from like 1945, there was about a 25-year period that was mostly, very prosperous with very, in 1952, the stock market notched like a 12% return. Inflation was less than 1%. You could get a 30-year mortgage for 4%. Unemployment was like 3%, 3.5%, something like that. It was like pristine, ideal economic conditions. They were running a balanced budget. Everything was perfect, and that was sort of emblematic of the era. And then, of course, that lasted about 25 years. There are some ups and downs, but for the most part, it was general prosperity. Starting in the 1970s, it flipped and there was a down cycle. And every stagflation. And even when the economy started to recover, in the 80s, my parents had an 18% negative amortizing mortgage for the house that we lived in when I was a little kid. I mean, it's like, how do people deal with that? And unemployment was still 7-8%. And so it was just general suffering. And then in the mid 90s, things kind of switched, and there's low interest rates and low inflation. And we've enjoyed that for about 25 years. Low interest rates, low inflation, high stock market performance, low unemployment. Well, guess what? Like, to me, I think we're entering the down phase now. I think this is the switch.
Yeah, that was my next question.
Mm-hmm. Yeah, this is absolutely a switch. And now I think we're looking at, this isn't like sit tight, guys, and let's suck it up for a couple of months and
buy the dip.
Right, buy the dip, and they're spinning this theory that like everything's going to go back to normal, prices are going to come back down, and all that stuff. I mean, I don't know if they actually believe that or not, but you have to be, I think, a complete idiot to think that that's the case. I mean, the only way that does happen is if there's a crash so severe that you get a horrendous, deflationary spiral. That's so bad that nobody even cares what price levels are at right now, because everybody's going under. So but more realistically, I just think we're in for a very, because of all these issues we're talking about, whether it's youth demographic trends and labor market trends and baby boomers retiring. So you got like people that aren't getting into the workforce, people getting out of the workforce, fewer workers. Most of the, we think, automation. Okay, yeah, but like most of the most brilliant technological minds are out there, trying to figure out how to get people to click on banner ads and engage even more time on Instagram and TikTok and stuff like, that's where like, that's tech today, is consumer tech. And so it's not making our lives more productive like it used to. So there's all these things that really impact that. And because I think there's so many reasons why inflation is going to be around for a while. I think inflation almost invariably leads to a recession, which basically means stagflation. And people already, I think, starting to tighten their belts. We saw this, I think, in the Netflix numbers, where people are just even started to say, maybe I don't need this anymore. I don't need 5 streaming services. I'm going to start canceling a couple. That's belt tightening. This is the sort of stuff that happens when prices rise. It causes corporate revenues to fall, it causes layoffs, it triggers recession. And this is a long-term thing. And when you think about these up phases where everything's great and prosperous, whatever, it can't last forever. It never has, and it would be stupid to think that it will. Yep. And I think we're in for a longer-term phase of slower growth, higher debt, higher interest rates, higher inflation, lower returns, on the traditional investments that have worked for so long. And I think people need to acknowledge that and kind of be ready for it.
Yeah, and another thing what I try to contemplate is what are going to be the quote unquote solutions from the central planners and the authoritarians, right? The reason, or one of the main reasons I would argue as to why we're going through this time of hardship is because the central planners distort the free market in the first place. But their solution is always more and more distortions, which obviously make it worse and worse and worse. So I get the same sense that that's kind of the phase that the 2020s, we're going to look back on the 2020s, and that's going to be kind of this decade of deleveraging or, fourth turning, whatever you want to call it. And it's just going to be compounded upon one central planning mistake after another.
Well, you're right. And historically, the turn back to the positive only occurs when people, the central planners finally realize, okay, we just have to take our medicine here. And sometimes that's too little too late. But, for the most part, that's when things really start to turn. And even then it takes a while to work out of it. So in the 80s, when, Volcker came in and said, all right, we got to do something about this inflation, that's the priority. And you just start attacking these problems one at a time and say, I'm prioritizing inflation. We're going to bring that down, and I'm going to ratchet interest rates up to the moon if I have to, to defend the dollar and bring inflation down. And that, that caused a lot of other problems in the economy. And then they started deregulating and they cut taxes, and they just dealt with sort of one thing at a time. And eventually, things got a lot better. And that's what it is. But the policymakers have to realize, they're out of options, and everything that they've been doing is all the wrong stuff. And we're just not there yet. They think that they can cure, like high prices that they've helped engineer through giving out free money by giving out more money.
Yeah.
Well,
because
we got to give people more money.
Putin's
Right.
fault,
It's all Putin. Right. Yeah. The Putin price hike.
Yeah.
It's corporate greed and it's Vladimir Putin. Those are literally the only two reasons for inflation.
Right.
And it's so offensive. It's so offensive when they say this stuff. And you're like, you must really think, people may be dumb, but they're not stupid, and when they see this sort of stuff, or they hear Pelosi, stand there and to go through the trouble of closing her thumb and her index finger to say that their multi-trillion-dollar spending plan will cost nothing. People aren't that stupid that they actually believe this, and so we're just not there to the point that these guys actually are recognizing we have to do something. But that something is going to be, it's painful. It means you have to produce more than you consume. You have to consume less. The government has to consume less. They got to curtail, a lot of these programs, a lot of the spending, the largesse. We can't just go and give free money. We've got to really ratchet up interest rates, which means the people are going to be consuming less. They're going to have to be working more, working harder, and it's not pleasant. And by the way, don't forget that Social Security is going to run out of money by the end of the decade too. So that's going to be like another $10 trillion bailout that they're going to have to contend with. So that's another crisis that's going to hit, probably the next administration, whoever that ends up being. But that's something between 2024 and 2028 that's going to be a huge deal that somebody's going to have to deal with.